I'm building a $1 million investment portfolio and sharing every step of the journey. Today, I'm comparing AMD and Nvidia, two stocks that have absolutely crushed the market. But the big question is, are they buys right now? Let's dive into their current valuations, analyst expectations, and at the end of the video, I'll share my thoughts on whether these are buys at their current prices or not. Here's the 10K to $1 million portfolio. Current value is $21,484. I have put $22,000 into it, and so we're down about $500 for a loss of about 4% since February 15th, which is when this portfolio was started. A lot of that loss is coming today. We're down 1%, and over the last week, we're down 11%. So before that, the portfolio was actually positive. And that's what we do here on this channel is we go from academic, where I share PE ratios, information, and research on stocks, to application of actually how I'm building this $1 million portfolio. You want to see what's in the portfolio? I share it all transparently. Just check out the past videos in the 10K to $1 million playlist on this YouTube channel, or my email newsletter, austin.substack.com, where I go into deep dive research reports on everything I own in the portfolio. First up, using Y charts, let's look at the history of these two companies. And as we can see, over the last 10 years, both of them have been mega winners. This shows if you would have put $10,000 into Nvidia 10 years ago, that $10,000 would be worth $626,000. Not a bad little gain there for the long-term investor. And for AMD, not nearly as good, but still beating the market, turning that $10,000 into $129,000 over 10 years. We've got Nvidia pulled up here. We could see over the history of the stock, it's traded at a normalized price to earnings ratio of 33.9. That's this blue line. That's what this blue line shows. It's grown earnings over its history, or the last 20 years, at 21%. So therefore, price to earnings times its growth rate, if that was 1, the PE would be 21 because it's grown at 21%, so the PE would be 21. That's what this orange line represents, is to kind of show you what fair value might be. But we could see, really at least since 2016, Nvidia has traded over that orange line. So I would be okay with that. But just by this black line, which represents price, we can tell it's kind of gotten way out of whack with its average PE ratio. So let's shorten the time horizon a little bit. Maybe the max history is not a good example. So let's go since 2012. We see that they've grown earnings at about 31%. So that brings the price to earnings growth up to 32. That would be the fair value. And then the normalized PE ratio is also right around 32. That's why these two lines are close together. So now if we look out, this is definitely, over its historical averages. And really we can see since COVID, it's just exploded over those averages. Before COVID, it was kind of trading under and then a little bit over. And so initially looking at this, it looks like Nvidia is too priced and I wouldn't be interested. But we also have to think about the potential future growth. So analysts on average think that the company is going to grow at about earnings at 27% in 23, 16% in 2024, and 16% in 2025. That's what the right side of this graph represents. So if we look at what those returns could be, and it stays at its normalized price to earnings ratio of 32, we're looking at an annualized rate of return of 3.1%. That's not interesting to me, and that doesn't give me enough comfort or margin of safety to be comfortable opening a position. As excited as I could be about Nvidia, it's just not there. Further, if we look at the fact that over this, since 2012, they've grown operating earnings at 32%, they're expected to slow down their earnings growth rate over the next 3 years. So therefore, if their growth rate is slowing down, Nvidia, in my opinion, doesn't deserve the same multiple that it's had in the past because it's not growing as fast. If we look at the forecast, this tells us that they're expected over the next really 3 years to grow earnings at about 20%. So that means that the fair value, if earnings is equal to earnings growth rate, would be at 19.9. Right now it's at about 50. If it trades down to 19.9, we're looking at minus 13% annualized return. Maybe it doesn't trade down that far, but in my opinion, it's certainly not going to be worth a PE of 50 if it's growing at 20%. So even if we go down to a PE of 30, we're looking at, basically no return. A PE of 24, and we're looking at negative 7% per year. And so if we wanted to also look at price to sales ratio for Nvidia, we can see that over the next 3 or so years, sales are expected to grow at about 20%. The normalized price sales ratio historically has been 14.8. If it stays at its normalized price sales ratio, which I wouldn't expect if sales growth is slowing, I would expect it to actually be under its normalized price sales ratio, we're looking at an annualized return of 6%. That's still not exciting enough for me to consider opening a position in Nvidia right now when I feel that there's better opportunities out there. But this is just my opinion. I obviously like to bounce my opinion off of Morningstar and other research services. Also, if I'm truly making a decision or really if I'm going to buy a stock, I'm going to do a lot more research than this. This is just kind of my scanning and initial research process to know where I should be spending my time doing my research. But Morningstar has it rated at 3 stars based off its valuation. So it has its fair value at 200 and its last close at 231. So a little bit pricey, not too crazy. And then the economic moat is wide and capital allocation is exemplary. Let's jump over to AMD and see how AMD stacks up historically. And we're going to start with the same process. So if we look at throughout its history, the average earnings growth rate has been about 19%. So that's what this orange line represents. Its normalized PE ratio has been 48, and its current blended price to earnings ratio is 32. Just an initial look makes me think that, compared to its historical average, AMD might be interesting. But we can't conclude that because there's still work that we have to do. So if we look out over the expected earnings growth over the next 3 years through 12/31/2024, we could see that earnings are expected to grow at 45%, 17%, and 9%. So there's a slowdown there. And I would be curious if that's, going to be a sustained slowdown or if that's just temporary based on some semiconductor cycle or graphics cycle or something like that. I don't know, and I haven't done enough research. If it stays at the price to earnings growth of 1, we'd be looking at basically a flat return between now and December 2024. It's currently trading at a blended PE of 32. So if it stayed at 32, and again, with significantly slowing earnings growth rate compared to what it's been recently, then we're looking at a 20% annualized return. If it dips down to a PE of 26, then we're looking at a 10% annualized return. At that point, AMD could be interesting. Let's take a look from a price to sales. And so here we see price sales ratio of about 7. If we take this out and it drops down to about 6, with sales expected to grow 11% in 2023 and about 11% in 2024, then we're looking at an annualized rate of return of 10%. If that drops down, 5, we're looking at 5.2%. And so we could see here with AMD as well, on a price sales basis, really it's been since COVID that this thing has just taken off. AMD is a very high quality company in an important industry. And so, this one is worth more consideration in my opinion. And so actually, might be an unpopular opinion, but right now I would choose, and I don't own either, I would choose AMD over Nvidia. I shared this with my email newsletter subscribers, austin.substack.com, before I bought these stocks. But I think CrowdStrike and Lowe's are better opportunities than AMD and Nvidia, and watch this video to find out exactly why.